Great, thanks, Matthew. I'm just turning on my screen sharing. All right, thanks so much. As Matthew said, I'm Scott Iyama. I'm a partner over at Orrick and Sutcliffe. I co-chair our global life science practice. And I thought what we'd talk a little bit about today was really just about the business aspects of a traditional preferred stock financing. We've done a number of these talks with the TDG, and we're very happy to be partnered again with them here. In going back on our prior talks, a lot of the questions were really focused around what to expect in a financing, and then talk about what we'd like to see and what we typically do in connection with the basic terms at a term sheet level. So my plan today was really just to walk through the basic business principles underlying some of the key provisions within the term sheet. As background, I've probably done 500 plus of these deals. We also partner with PitchBook to put out a lot of information around data of what we see in the market, trends, et cetera. So definitely would like to make this as useful as possible for folks. So to the extent you have questions about what is customary, standard, what we're seeing from traditional institutional VCs versus corporate VCs, et cetera, would love to chat through it. But the key piece here is really just use this as a resource in any way that's helpful. The way that this presentation is set up, and I'm happy to provide a copy, there's a lot of information in here around the organization of the company, what to expect from a timing perspective as you work with VCs, et cetera. So I'm going to skip quite a bit of those early slides, but if you have questions, I'm happy to stop and go back to them. What I'd really like to focus on is what are the key terms of the term sheet. So these are going to be the traditional terms that you'll see from institutional investors at the seed stage or the Series A stage. What we're going to focus on here are really going to be the equity form of investments. There's obviously safes and convertible notes that you may do in advance of these types of transactions. Typically for equity financings, institutional VCs are going to prefer equity financings. Angel investors and some of the early stage funds may do safes or convertible notes, but assuming you go down the equity route, I typically break up the terms of the transaction really into 4 key buckets: valuation, control, the mechanics of how these different types of transactions affect your ability to exit, and then really just kind of the catch-all bucket of everything else out there. And again, please interrupt me as we go through this process. So to start, let's talk about valuation. This is the first question we always get from entrepreneurs as they're going through their first financing is, how do we think about valuation, and am I getting a good valuation? So at a threshold level, the way that most valuations are driven is really going to be a function of how much capital the company is going to need. Usually you're thinking about the capital raise, at least at this initial raise, of effectively a year up to 2 years of capital, really to get you to that first milestone, to get you, in a good position to accelerate the company and move into your next equity financing. So the questions become, what are the equity targets? How do we think about valuation, and what's the basic calculation? The easy way to think about valuation is really a function of how much of the company are you giving up in order to take the new capital. Oftentimes, institutional investors at this stage have a very particular target range for their ownership. So for example, certain VCs that we work with at the initial financing want to make sure they have at least 25% of the company. As you think about how much money you're going to need for your capital run over the 2 years, maybe it's $5 million. Magically, your pre-money valuation is therefore $15 million. your post money is 20 with the 5 million in, and the investors get their 25%. If instead you only needed 3 million, you might be looking at a pre-money valuation of 12. So valuation is just another way to think about ownership. And the important piece to that is that if you're viewing this from the perspective of ownership, there's a number of different levers that come into play on how you think through those different factors that go into ownership. Oftentimes we'll have founders and entrepreneurs that just view ownership strictly from a pre-money basis. The levers that go into this are, what does pre-money mean? And I thought I'd walk through a couple examples here. These were examples that came up in our last talk with the TDG. And I thought it'd be helpful just to give a little bit of quantitative color to this. So in kind of an abstract here, if we have an investor that is looking to own 30%, looking to put in $3 million into the company, and we have a $7 million pre-money valuation. That first column is really just what the existing capitalization of the company looks like at the time the money comes in. And there's no changes to the capitalization. The investor is just putting $3 million right on top of that. And you can see how the dilution comes in across that. So the investors are putting $3 million on $7 million pre-money. So they're taking 30%. The founders who held 6 million shares are going to hold 60% of the company, and so on. This is just a non-adjustment to the existing capitalization, and it's a very straightforward, mathematical process. What changes here is if you take the same scenario, and what is typical for an equity financing is to make some changes to the existing capitalization to account for the growth of the company. The primary thing that changes here is the size of the stock pool. So oftentimes when you're having these discussions, there'll be a conversation with your investors about how much equity the company is going to need to issue to new employees and consultants over the next couple of years, and make sure that there's a reserve for those shares in the capitalization. Now, when you create this reserve, standard practice is to put whatever that reserve is into the pre-money capitalization. So whereas in the prior example, we only had a 500K available pool, we're now increasing this pool size. And the way that investors think of this pool size increase is really to think about it on a post-money basis. So after you close your financing, how much equity are you giving away to the new employees, consultants, et cetera? Typically, we see something for early stage companies around 10 to 15%. You're going to have to give away a material amount of capital to preserve, or a material amount of equity to preserve your capital. And 10 to 15% is relatively standard. We use 20% here to frankly make easy math going through everything. But that increase, by virtue of putting it in the pre-money, dramatically changes the founder ownership of the company. So even though we're still saying it's a $7 million pre-money with $33 million in for an investor ownership of 30%, there's a dramatic change in how much the founders own. So you have to look a bit beyond the top line numbers of just what's pre-money and what's new money in. Once you get through the process of walking down the model of how is the valuation going to look and where are the different allocations of the equity, the natural transition is to think about, well, based upon the dilution, et cetera, how does this affect control, right? How are we as the entrepreneur going to be positioned to make sure that we have influence over the direction of the company? And from the investor perspective, where are they going to have affirmative rights to veto different types of transactions, exert their influence to make sure the capital is used efficiently, et cetera? And there's three large categories where this falls into. The first is at a basic corporate law perspective. At the corporate law level, you're selling a different type of stock to investors. You as founders are all holding what's called common stock, and the investors are buying what's called preferred stock. The preferred stock are going to differ from the common stock shares primarily through the different rights, preferences, and privileges that are raised as we talk about later on in this process. The common stock are going to be at a much lower price, and that enables you to sell the preferred stock based on the rights, preferences, and privileges at a much higher price. Under corporate law, those different classes have different voting rights. So there are certain types of transactions, there are certain types of votes that are necessary in different categories where you're going to have to get a common stock vote, a preferred stock vote, or a vote altogether. So it's important to kind of keep that in mind from a basic corporate law perspective. And as you're stacking these on, you might have a Series A vote, a Series B vote, a Series C vote, and a preferred vote altogether, right? So there is a difference in the type of stock that is necessary for different votes. The other pieces of control are going to be outside of the baseline corporate context. How can the board and a minority stockholder exert control? So in our example, where the investors are holding 30% of the company, they want to make sure that they are able to exert control as minority investors. At the board level, the key piece is really going to be the core composition of your board. Institutional investors are going to want to have a seat on your board. They're going to want to have the right to designate who sits in that seat. And they're going to want to make sure that there's a lot of clarity around how those other seats are filled. When I think of board members and board composition, the most important part for me is really predictability, right? It's how well can we anticipate and have clarity around how certain board members are going to act and how certain seats are going to be filled. From an investor perspective, they're going to take at least one seat for their investment. And so the question then becomes, how much control are you as a founder going to be giving up in this initial round? Are you going to hold a minority of the number of seats on that board, or are you still going to have majority control? And this is where the negotiation goes back and forth. There's also important things to think through on how you can limit certain rights to designate board members. And this is one of the common issues that we see both as investor counsel and on company counsel in these different contexts. For example, if you are giving a set of stockholders, a set of individuals, a class of stockholders, the right to designate board members, you want to be thinking through how that right is limited. For example, one of the pieces that you can qualify is if there's a group of common stockholders that have the right to designate a seat. We want to make sure that those are common stockholders that are aligned with the company, they're involved with the company. So sometimes you can say it's common stockholders that are then providing services as an example. And the way that you enforce all of this is all through the voting agreement. The voting agreement is going to be one of the 5 core agreements that you'll see in these types of transactions. I put up here board observer rights. Board observers don't have voting rights as board members. They just have the right to attend board meetings and oftentimes receive board materials. It's a way to keep investors involved at the board level, but not have a board seat. So oftentimes we do see these conflated in discussions. You want to make sure that you're really clear on whether or not you're giving up a board seat or a board observer seat. The way that you can start to manage your investors, if you have multiple investors coming in, is to give the lead investor, for example, a board seat and give some of the smaller investors board observation rights. So you're still getting the benefit of their insight into the board discussions, and they're getting their objective of getting insight into the company by being in the boardroom, but you're not giving up control. Just popping open this question really quick. So I can answer this really quick. And the question is, how should option exercise prices be set after the Series A? So an important piece separate from all this is how do you deploy that stock option plan that you've reserved for use? That stock option plan, typically post-financing, is going to be deployed in stock options. There's different forms of equity that can be issued from the stock plan, ranging from direct stock purchases to options, et cetera. Typically, it's going to be stock options. The way that those are priced is post-financing, you're going to get what's called a 409A valuation. 409A refers to a tax code section that relates to deferred compensation. And not following the rules around 409A or not sitting in certain safe harbors can have really draconian tax effects upon the recipient. So the proper way to do it at a high level is to get a third-party independent valuation. There's tons of different valuation shops out there. They'll give you what's called a 409A valuation, which is going to value the common stock at its current fair market value. The board can then rely on that valuation to price the options. To the second part of that question is, how does that price relate to the preferred stock? The common stock is going to have a much lower price than the preferred, right? We mentioned early on that the preferred stock is going to have all these rights, preferences, and privileges, and that is going to justify the higher price that your investors are paying. So the common stock is going to be a fraction of that percentage. The relative fraction of that percentage is really going to change as the company scales and matures. But early on, what you'll typically see that, depending upon the industry, different industries have different discount factors and et cetera. It'll probably be somewhere around a quarter of the quarter of the price of the preferred. It may range somewhere between 20 to 35-ish% of the preferred price, depending upon where the company is at that initial financing and a couple other factors, but it's generally within that range. And it's important to go through that process, again, to make sure that you're not going to have any tax issues down the road. All right. The next piece of control, protective provisions. So these are very common in every venture financing. The protective provisions relate to stockholder votes. So a protective provision is that minority protection that we talked about earlier. For purposes of the investors, they want to make sure that they have the ability to stop certain types of transactions where they feel that there is either disalignment with the existing common stockholders or where there's a material change to the company and it's really their capital at play. This list of protective provisions can be, anything in the range of 5 or so protective provisions to 15. These are the typical protective provisions, and they're really material transactions to the company. So for example, your investors are going to want to have a blocking right on the ability of the company to sell itself in an acquisition, right? Your investors are investing at a certain basis in the company and a certain valuation, and they're going to want to make sure that they have the ability to block or influence the vote on the type of return they're going to get. Additionally, if you're borrowing against the assets of the company, if you're changing the business in which the investors put their capital into, you're reducing the rights of these investors, et cetera, they want to have a blocking right. So even though they're going to hold a minority of the outstanding shares of the company, when you want to do one of these transactions, you're going to have to go and get their permission. These are really important to think through. The dangers that I've seen in types of different types of transactions is these typically get cookie cuttered a little bit. There are certainly 5 or 7 that are very standard in market, but the more extensive list, oftentimes folks don't think through as deeply as they should. And why is that important? It's important because all of these terms and restrictions and rights that you're giving your early stage investors, they're going to put a line in the sand for your next round. So if you have 15 different protective provisions for your Series A, you're going to have at least 15 for Series B. You're not going to be able to reduce these. So where do you want to think through this, right? You want to be thinking through a couple different pieces. One is, where do you think that there is core disalignment potentially between the common holders and the preferred holders? And make sure that while you're respecting their desire to have certain rights to block, et cetera, make sure that they really are core rights. They're just not throw-ins there that you're going to have to do as really an administrative matter to go out to your stockholders to get approval. These are the types of things that just slow the business of the company. It's the legal machinations that get in the way of the business. The other piece to think through here is, what else can we do besides get a stockholder vote? And for example, in scenarios where we're required to get a stockholder vote, an important carve out to think about is, if the board already approved it, can we forego the stockholder vote? So I like to throw this carve out in there where there are alignments from the fiduciary duties of the board members and the stockholder votes. Again, you're trying to minimize things that delay or impede the business from moving forward. All right. Exit mechanics. So this is one of the most common questions that we get, excuse me, right after valuation from entrepreneurs, which is, if I sell the company, how are the proceeds from that sale distributed? And what rights do the preferred holders have to take capital before I, as an entrepreneur, are able to get that? There's two really important concepts to be paying attention to, and these all relate to a general category of what's referred to in the term sheet and kind of nominally as the liquidation preference. It is, what is the order in which your stockholders are paid on a change of control? The two key pieces are participation and preference. Preference speaks to the order. Who is getting paid first, and how much are they getting paid first? Participation is, after you've satisfied the earlier preferences, how do the remaining assets get distributed? And we spent a lot of time on this in some of our prior talks. And I thought what might be helpful in this discussion is really to kind of go through some examples and flag where there's a little bit of disalignment and how the proceeds differ in each of these scenarios. So the gold standard of kind of liquidation preference mechanics is what's called a 1x non-participating preferred. What that means is a 1x preference. So when there is an acquisition, the first available proceeds go back to repay the investors their amount of their investment. And then the balance of the proceeds go to the common holders. This is important because it causes an economic decision on the part of investors, whether or not they take just their preference or they convert to common and they participate along the common as a common holder. So these are numbers that we use based upon our earlier model, which was an investor putting in $3 million at $1 per share. In this exit scenario, the post money of that model that we had put together was a $10 million post money valuation on the company. So what that means is, up until that $10 million valuation, the preferred are going to stay as preferred before and not convert to common. So in this model, what you'll see is the preferred get their $1 per share back. This is the $3 million line, so they get their $3 million. $3 million goes to your preferred investors first. They stop, and then from that point forward, the common holders get it until you get to a $10 million exit, and then the preferred convert to common because they're better off being common holders and participating going forward. Couple consequences to flag in this scenario. One is this plateau where the preferred are not taking any proceeds means that they are effectively indifferent as to the valuation of the company between $3 million and $10 million, because that increase in value only touches the common holders. That's only the common holders benefiting from any increase in value. There's obviously disalignment here because the common holders are going to want more value. Preferred holders aren't going to fight for you until you get to this point. If we were instead to move from just a 1x preference non-participating to a multiple on that preference, what that does is obviously shifts the curve until the point in which the common holders can start taking proceeds from the distribution. So in this scenario, rather than the investors just getting their $3 million back before the common get it, they get $12 million. So if the value of the acquisition, oops, sorry about that, is $10 million, the common holders get nothing in this scenario. This just shifts all of the curves downstream. It's important to think about this because the plateau where there is this gap between alignment on building value to the common holders is extended. And while you don't often see multiples on the preference, we do encounter them. There are some funds that ask for 2 or 3x on their preference, and oftentimes people just kind of give that away. It's really important to think through how it affects alignment on the exit, how much your investors are going to fight for you to get a greater value, and when you as entrepreneurs are going to be able to take some money off the table. So that was all focused on preference. What about participating? So participating in the non-participating model that we just talked about, you're forcing the investors to make a decision because the investors can either take their preference or convert to common holders and basically participate in the distribution on a pro rata basis. They have to decide what is in their best economic interest to do so. If they're participating, you're removing that inflection point. Participation just means that the investors first get their preference, and rather than the remaining proceeds going to just common, they're going to common and preferred. So the participation is the piece of everything after the preference. They get a part of that. Sometimes you hear folks refer to this as double dipping. This is really important. There's some slides on the back here, again, as a precedential matter. I've seen some entrepreneurs accept this construct. Again, gold standard is 1x non-participating, but I've seen some founders accept this construct where they're having trouble raising capital and they don't think this is too big of a deal because they're only sharing in part of the proceeds. Again, the danger here is when you start to stack this. If you're giving participation rights to your Series A, you're probably giving it to your Series B, et cetera. So the amount that is going to your common holders gets dramatically reduced because this piece, the preference stretches out and the curve stretches out. So all of this is to say, the important part of liquidation preference is really to focus on the preference and participation. When we had our earlier talks, I think we had run into a couple different companies that had just glossed over this a little bit, but this is really core to effectively what you as entrepreneurs are going to be taking home at the end of the day. The other piece of the exit mechanics is how do we get there, right? Who has to approve us selling the company, and how do we think about that in the context of an acquisition? At the top level, the board has to approve all sales of the company. So it's if you're selling the company, you're selling all or substantially all the assets of the company, you're doing an exclusive license, et cetera, the board has to approve that just as a governance matter. The second step is the stockholders. So we talked about two different pieces of stockholders. Which classes of stockholders do we need to get to approve it? And secondly, to the extent that there's protective provisions, what subset of minority, or even at that point, they might be the majority of the preferred holders do we need to get to approve the liquidation? The reason why we differentiate between the board consent and the stockholder consent here, an important differentiation is that the board members have fiduciary duties. So they can have to vote in a manner that takes into account the best interest of the company and stockholders. The stockholders don't have those same restrictions here. They can reject the sale of the company for basically any reason. There's some limitations, but it is not, they're not bound by duties to the company in the same way that a board is. So you could have disalignment where you might have an investor who is a board member who's going to vote in favor of the transaction as a board member, but then as a stockholder might take a different view. The ways to address these different types of incentives, also to be thinking about all of the variety of stockholders out there, is to have what's called a drag along right. And the reason I bring this up, it came up again in one of our earlier discussions, is folks kind of giving this away. Drag along is the idea that once a certain threshold of stockholders, boards, et cetera, approve the transaction, then all other stockholders are required to vote in favor of it. So for example, if you were to get the board and a majority of the stockholders to vote in favor of selling the company, then by contract, you require all of the other stockholders to vote in favor of that transaction. Doesn't matter if they don't like it, they don't want to do it, they're contractually bound to do it. The key piece here to be thinking through are, what are those triggers that allow the drag to be induced? It's typically a board trigger and some stockholder vote. The key piece here, just as you're thinking through the key pieces of who has the right to designate directors, is what subset of stockholders is required to induce the drag? Is it just a simple majority of all the stockholders? Is there a separate vote of the common and a vote of the preferred, et cetera? And the reason why that's important is you as entrepreneurs are also subject to this drag. And over time, you're probably going to be the minority stockholder. So if it's just a simple vote of board and majority of stockholders, you might not be able to block. But if it's board, majority of common, and majority of your investors, you get a blocking right. So there are ways for you as entrepreneurs to make sure that you're maintaining some control over the exit process. There's lots of debates around whether or not drags are enforceable, et cetera, but I think this is an important point from really a leverage mechanic in the context of an acquisition. And this tends to get overlooked oftentimes by early stage entrepreneurs, et cetera. One thing to always flag too, the last piece right here, if you are core to the company, you always have a voice. The buyer, unless you're just a simple asset play, is going to want to have you involved. Typically, you know, as academics, et cetera, you are going to be the world expert on the technology that's being commercialized by this company. Buyer is going to want you involved. So you as founders are going to have some influence on this process, what the terms look like, et cetera. And, you know, I think people tend to disengage a little bit in the process of selling the company. It's important to make sure that your voice is heard here. Everything else. So everything else is just kind of this broad catch-all category that we can run through relatively quickly here. Everything else is really the rights that don't typically touch on control, some of the key economics and voting dynamics. They are very important, so make sure that you're reading them and going through them carefully with your lawyer. But they are oftentimes more technical from a legal perspective rather than from a driving business perspective. Dividends are a classic example of that. I've seen some less experienced or less sophisticated entrepreneurs that will spend a lot of time negotiating a dividend. A private company isn't going to issue a dividend. In the 15 years plus I've done this, I've never had a client issue a dividend. So spending time and negotiation capital on a dividend is not a good use. The other categories that will fall into here are redemption rights, a few other pieces. The couple that I would like to flag are around conversion and contractual investor rights. Conversion, the reason why this is important is we just spent a lot of time talking about different control mechanics and how common holders might be disaligned from your investors and how those votes are different and the different dynamics that run into play here. An important thing to keep in mind is that the investors at any time have the right to convert to common. And that's important in a couple contexts, right? We talked about it being important in the context of a liquidity event where they have to make an economic decision whether or not to be a preferred holder or a common holder. But for founders and entrepreneurs, it's also really important because it allows the investor to convert to common to affect the voting dynamics. So for example, if you set things up and we do have a common holder block, the investors can always convert to common and influence that vote. So even in the context of a drag along, for example, if there's just a simple, separate common holder vote, you may be in a position where the investors hold so much preferred stock that they can convert part of that preferred stock into common stock and change and control that common vote. So it's really important to think through how the conversion mechanics work, how the anti-dilution mechanics work, et cetera. I'm going to flip through this pretty quickly here. The other kind of rights that come along here are rights in connection with the public offering, the information rights that your investors are going to require that the company deliver, et cetera. These are all fairly standard. The one I want to pause for a minute on are the preemptive rights. These are the pro rata rights that your investors are going to have. This is something, again, that I think people throw away without going through in a lot of detail. Pro rata rights are really just preemptive rights. It's the right of the investors to participate in the next round to maintain their ownership percentage. And why is this important? It's important for a couple of reasons. At a practical level, you want to make sure that you understand who is going to have the right to continue their ownership level in subsequent rounds and how that affects your subsequent round raises. These are typically limited to a subset of your investors, those that put in a substantial portion of the money. But this can influence how you allocate subsequent rounds. And that's important because if you have a Series B round and you have a Series B investor who's taken the position we talked about earlier of, I need to hold X percent, their ability to get to X percent is going to be compromised potentially by the right of your existing investors to participate. So it's really comes down to how you divide up the pie. And I think it's important to make sure that you're limiting these rights in a thoughtful manner. It's important both for this concept of who's going to maintain their ownership, but also who you have to go to to satisfy this right. We've seen some instances where, for example, a company took on an enormous amount of convertible notes or safes, which guaranteed each one of those investors pro rata rights. we've had to deal with that going forward, which means we go out to 20, 30 people every time we do a round. And that's just painful, cumbersome, and expensive for the company. So this is one to make sure you understand and make sure that we're thinking through. And importantly, this exclusions. What will the company on a prospective basis be doing from a stock issuance perspective that we don't want to have pro rata rights apply? You might be giving warrants as part of a commercial deal. That's not for raising capital. That shouldn't have pro rata rights, et cetera. So particularly for life science companies, this is something we want to be thinking through in great detail. The other piece are these negative covenants. Negative covenants are just restrictions on the company. These are contractual rights that are different from your protective provisions that give one or more investors the right to stop, prohibit the company from doing something, et cetera. The issue with these types of covenants is it can really get in the way of the business. Sometimes the covenants are extraordinary, which are fine. You know, the company can't do X without a certain investor's approval, and that X might be, you know, borrowing several $1 million. That is a more reasonable restriction than the company can't enter into day-to-day contracts with certain customers. You want to make sure as you go through these covenants, it aligns well with the business, and you wouldn't, you know, inadvertently breach them. Once you start to go down the road of inadvertently breaching them, it starts to become messy. So again, they're just things to be thinking through. One step back, as you're looking through the documents, we talked about the voting agreement being an important agreement. There's really 5 core agreements in these types of transactions. And if you want to take a look at what samples look like from a relatively customary industry perspective, the NVCA forms are probably a good way to start. It's your certificate of incorporation, which lays out the rights, preferences, and privileges of the stock. That's where you'll see these protective provisions, liquidation preferences, et cetera, that we talked about. There's the stock purchase agreement. That's the mechanics to sell the shares. There is the investors' rights agreement. That's going to have all of these contractual rights that we briefly skimmed over that your investors are going to have. The pro rata rights, the information rights, the registration rights, the covenants, et cetera. The voting agreement. The voting agreement is going to have the structure of the board and your drag along. And the last is the right of first refusal and co-sale. I want to go through this very quickly just because these rights on the right of first refusal and co-sale, they're transfer restrictions on founder shares. These are encumbrances on your ability as a founder to sell your shares to any third party. The right of first refusal is that if there is a third party that makes an offer to buy your shares, the company and typically the major investors have the right to buy your shares first on the exact same terms. If the company and those investors don't exercise that right of first refusal, the investors have the right to step into your shoes and sell their shares on a ratable basis to that third party. The whole idea here is twofold. One is to maintain a closed network on who is holding those shares. So for example, the company might not want you selling shares to a certain competitor, a certain fund, a whole bunch of different reasons. And also from an investor perspective, they don't want you as a founder taking liquidity before them. So that's why the co-sale right comes into play. Just to flag, this is different than the conversation around the vesting of your shares. The vesting of your shares is what happens to your shares if you were to stop providing services to the company. So the right of first refusal and co-sale are transfer restrictions. Vesting all relates to your ownership and your accruing ownership into the company. These two often get conflated, and sometimes there's a little bit of a back and forth in terms of negotiation. The vesting is really important to the founders individually. and their ability to hold and maintain their shares as they earn into them throughout the life cycle of the company. The contractual piece in connection with the financing is really the transfer restrictions. And the vesting will come up as a piece of the negotiation. So it's important to keep them in mind and the fact that they are different. Oops. Last thing to flag, and I flag this because there are only typically two provisions in a term sheet that are binding: the confidentiality provision and the no-shop provision. The no-shop provision is just an exclusivity provision. It's once you sign the term sheet, you are agreeing to stop negotiations, solicitations, everything related to selling the company or raising additional capital. The idea there is you're locked in for a period of time with this investor. You are not shopping the term sheet, the terms, the deal, et cetera, to any other investors. So this is, once you've made the decision to go with this investor on these terms, this really does lock you in as a company. If you got a better deal in that no shop period, there is zero obligation for the existing investor to increase their terms, to change their terms, to accommodate that, et cetera. And they don't frankly want you out there looking for that. They want you focused on closing the deal and running the business. So the no shop is really important. You want to make sure that you enter into a no shop period that is reasonable. You want everybody hustling in this. You don't want a financing that's dragging on, that's taking you away from the business. Typically, rule of thumb is around 30 days for institutional investors. Sometimes corporate investors will go a little bit longer because they need more time to run it through their processes and their corporate parent. But you do want to have a hard end date on the exclusivity provisions. This, like the beginning, is just a bunch of things, just tips on how to go quickly through the financing. Bottom line is just get the company as clean as possible going into your financing. It's I was just on a panel with a series of entrepreneurs, and the entrepreneur kept talking about the financing and the IPO and the acquisition is landing on the moon, right? It's this terrific accomplishment, and it really is. But the way I would frame that is a little bit differently too, which is what's really important is the launch. And if you're off by a degree or two, you're in the sun. And so all of this stuff early on, as you organize the company, as you get everything lined up going into the financing, can really affect both the ability and the efficiency to get to that close. And candidly, how sophisticated you look to the investor. You want to create a very streamlined process. You want to go quickly, cheaply, and you want to make sure that the investor fully believes in your ability as a manager of the company, as a fiduciary of the company, to run it properly. And this is a good way to build that foundation of establishing that. This is one where I think you really want to leverage your service providers to be in front of it. I know for me, the worst thing that I would see is someone showing up on my doorstep with a signed term sheet. I think it's, once you sign that term sheet, you lose all your leverage. You lose any type of ability to negotiate terms, et cetera, to coordinate. So the front end of organizing the company and organizing this process, make sure you're thinking through and make sure you're using and leveraging your service providers as much as possible. There's some just tips and hints, but I know we're running towards our end here, and I wanted to make sure I answered questions. So happy to address any questions, anything folks would like to talk about. I know that was really quick and a lot of information. If you'd like to talk about what we're seeing in the market, et cetera, happy to answer.
So just to reinforce that, now that we've hit the top of the hour, if you have any questions, please put them in the Q&A box, and I'm sure Scott would be happy to answer them.
All right, Matt, quiet group.
Yep, looks like it. Of course, it's their prerogative. In which case, Scott, I really want to thank you for that really comprehensive walk through the term sheet and what to expect in spinning out a new startup. It was, at least for me, really educational, learned some stuff that I didn't know about last year. Looks like we have our first question. So I'll cut off my wrap-up speech and let us answer this one.
Sure. The question is it reasonable to ask safe investors to accept common stock? I've never seen it, put it that way. So we actually drafted the SAFE instrument with Y Combinator a number of years ago. And the idea behind it was to set kind of a streamlined process as a baseline for investments. The SAFEs have its pluses and minuses for sure, just like any other equity investment. But the idea is that the investor is coming in early to help make their capital available in a quick and efficient manner. As you saw, for an equity financing, there's a lot that goes into it. There's a lot of documentation, there's a lot of negotiation, and there's a lot at the business level, right? Just at a top line, negotiating what that valuation is going to be can oftentimes be super time consuming and not really well productive. Safes like convertible notes are a vehicle to remove a lot of those barriers. There's really not much negotiation to the documents, and you don't have a built-in valuation. So the expectation from the investor's perspective is what we are doing is we are kicking the can down the road on how to value the company, how to create that valuation, and how to negotiate those terms until you bring in a large lead institutional investor, and we're going to follow their lead. We're going to rely on them to negotiate those terms, and we're going to get the benefit of those terms, right? We're just putting our capital in early, which is why you have either the discount or the valuation cap or both. They're getting the risk adjustment for putting their capital in early, but they do want the same types of rights, preferences, and privileges as the investors coming in. One thing that's important about the safes is similar to convertible notes. Convertible notes don't have this as a default. They don't convert into the exact same security as the next round. That's a shadow series, and that's a separate conversation, but they are economically aligned in a way that makes sense, but they are preferred shares. The common stock, that would be a lot for any investor to swallow.
All right, thank you for that. Since I went prematurely last time, I'm going to give it a couple of seconds before we wrap up. All right.
I think you're good.
Yeah, looks like we dried up the questions. So Scott, thanks so much for joining us today. And those guests of us who are on the webinar, please note that we have the series running all spring, every Friday, 12 to 1. So please join us again next Friday and the Friday following to learn more about what to expect for spinning out your startups. Scott, thanks again, and let's catch up soon.
All right. Good luck, everyone. Take care.
Have a great day, Friday.